Hi, I'm Sherri.
And I'm Lana, and this is Real Estate Tips with SNL. Sherri, what do we got going on today?
Well, today, Lana, we're going to talk about unlocking home ownership.
Nice.
Insights from a mortgage expert. And we brought in our local mortgage expert, Jacqui Keogh from Salem 5 Mortgage.
Yay!
Yay.
Excited to have you here.
Thank you.
Let me talk a little bit about Jacqui. Let me tell you all the highlights. VP Senior Loan Officer at Salem 5 for 19 years, 25 years in the mortgage business. Experienced with construction, renovation, modular lending, mass housing, VA, FHA, jumbo loan products.
Oh, lots.
She's also taught the first home buyer class at New View Communities since 2002. She grew up in Leominster. She currently resides in Hubbardston with her husband, Ron, and she has 3 grown children, Shane, Courtney, and Tyler. And she's a nanny to Lucy and Weston. Welcome, Jacqui.
Thank you, guys.
Yeah,
so
thanks
nice
for
to
coming.
be here. Yeah,
Thanks for coming.
Sure.
So fun fact for you, Jacqui actually handled my mortgage and Lana's mortgage.
mine. Both of them.
So she is definitely a trusted professional, and we are thrilled that you were able to join us today. Now, I know that you have taught the first time home buyer class, and you're clearly an expert in that,
Yep.
but I thought it would be fun to start today with the move-up buyer. And again, when I say buyer, you're going to say borrower.
Right.
It's the same person, but in case we are using a different terminology, I thought I'd put that out there. So
Sure.
go ahead, Jacqui, tell us about that.
So first of all, thank you for having me on your show.
Yeah.
And Lana and Sherri both understand the importance of working with a local lender and also the importance of a mortgage company that is going to service the loan. And I know that was really important to you when you and Jim were looking and buying your house.
I'm glad you brought that up. I'm just going to interrupt you real quick.
Yep.
So sometimes you're going to a mortgage, I don't even know, is it a mortgage broker versus a
Lender?
Lender.
A
Like,
bank?
what
they're
does
all
all
lenders.
that mean?
So we're all lenders.
Yeah.
So typically, if you go with a mortgage broker, their funding is coming from like another bank. They're not funding their own loans. So the funding is coming from like Chase. They might be selling the loan to Chase. And sometimes the borrower doesn't know where their servicing is going to be on their loan until after it closes, and then they get a letter.
So you mean like they all of a sudden they have a new lender they're paying their mortgage to?
Right.
Right. So with you, we stayed with Salem 5. I'm still paying Salem 5.
Yeah,
Right.
we service our own loans. So we all lenders, they sell their loans to Fannie Mae.
Yep.
And then they retain the servicing. Salem 5 does both.
Okay.
We sell most of our loans are sold to Fannie Mae, but we have what we call portfolio loan products. And those are products that for the very well qualified borrowers, and we keep them in-house, such as the bridge loan. Such as you. And that's why.
What's a bridge loan? You just said bridge loan.
Yeah, bridge.
Yeah.
So a lot of people say, well, can I get a bridge loan to buy my next house? And in the past, most people who, if they got a bridge loan, it meant that they had to qualify for the house that they own. The bridge loan itself, which is the loan on the equity in their property.
Oh, you're right. Yeah, okay.
And the new house. And
that's a lot.
That's a lot. That's a lot.
Wow.
Cha-cha-cha-ching.
Cha-cha-cha-ching.
Yes.
But Salem 5 has a program only for our portfolio loans, and you have to put 20% down because we can't sell the loan. We can't get the loan to have PMI. The PMI companies are kind of wonky on that. So what we do is say you have a borrower whose house is worth $500,000 and they're a move-up buyer.
Yeah.
And they only owe like $100,000.
Right.
We will lend up to 70% of the $500,000. I don't have a calculator, but up to 70% of the $500,000 minus the $100,000, and that will be a bridge loan.
Oh.
It's a loan on the equity.
Yeah.
And they can use that as their 20% down to put onto the next house. Here's the fun fact. We won't count their current mortgage payment or the loan on the equity line in their debt to income ratios.
How do you get away with that?
Well, see, because we're fancy.
I love it.
I'm so fancy.
So actually,
But they have to have 12 months of the mortgage payment on the new house in the bank. And it has to be their own money. It can't be a loan. It can't be gift funds. We really need them to have their own funds for that. Okay. And their house needs to be at least listed. Doesn't need to be under contract, but it needs to be listed. So you want to get the equity line. The equity line and the bridge loan, it's the same thing.
Yep. It's just different what Salem 5 is doing for the bridge loan where before you had to qualify by doing those 3 items. And now you do. Okay, that makes sense. Okay.
Right. Now, this is sort of where you and I come in, Lana, when we're working with a seller client that, is a move-up buyer there or move down, whatever it is.
They could be empty nesting.
They're going to sell their home and they're going to buy something else. And it's a little tricky, especially in a market where we have low inventory and people are a little nervous about putting their home on the market and then not being able to find something. So this is really a great tool. I love that you're saying that.
And no contingency to have to sell.
Right. And they have their home listed, but it doesn't mean it's under agreement. Now, I imagine that for you, what you need from us as real estate agents is to provide a market analysis so that you know the value of that house.
Right. We'll use our own market analysis too. Like it has to go through, our vetting process to come up with the value on the house too. But I'm sure if you provide us comps and things like that, we can certainly present that to the bank. Okay.
Yeah, I think that comes into play because I know a lot of times when people are not sure when to list, but they want to list, but they want to know the value and stuff, we come in first, give them a value, they go and talk to the lender and they find some solutions because I think oftentimes lenders only want to talk about what you're qualified for instead of looking at the big picture saying, well, why don't you pull a bridge loan to help out?
Right.
I don't know.
Because I think it's right now in this market and environment, that's the stickiest point. Like, where are we going to go? They can actually move into the new house.
Right.
And close on it before they close on the house they're selling.
Right.
Which... That is huge.
That's huge.
I have to tell you, the stress of trying to close and move out of a house, close, then move into a house. And, you might have a day that you've got your belongings all packed up in a truck somewhere and you're in a hotel or you're sleeping on an air mattress or, okay, never. I don't do that.
And I'm going to add one more layer to this. So because we're keeping that 30% equity as like our buffer, right? So say they sell their house and they've got like this, they still have like a little nest egg of money, right? After paying real estate commissions and things like that, we will allow a borrower for a small fee to take that money and put it down onto their loan balance. And we will recast the loan to the new payment, not changing their rate or anything.
Right.
And recast the loan.
And is there a cost involved in doing
I think it's like $100.
Oh, really? All right. So this is not like a refinance.
No,
this is
we're
just
not refinancing. Recasting.
I like that.
Recasting and dropping down the amount that they borrowed, right?
Amount they borrowed and then lowering the monthly payment.
Most people...
I have a lot of people that that buy without selling their house. I mean, because they can, because they have the funds to be able to do it. And they recast. All the time. We do this. I do it with construction loans. Like I just closed a construction loan in Phillipston. They sold their house afterwards, and now they're putting like $250,000 from their profit down on their construction loan. So
that's great. I mean, I think that even if people can afford it, no one wants to hold on to 2 mortgages and do all of that.
But they also don't want to have to pay refinancing fees all over again.
And waiting for when to refinance, right?
Right.
So, I mean, I know. Right. That's really interesting too.
It's there's a couple of moving parts there that we have to work through with the borrower and qualifying.
But I'm sure having a conversation with you, just a conversation.
Pick up doesn't
the
cost
phone.
anything for a
Right,
conversation.
doesn't cost anything. And I know I have a lot of sellers that are thinking about retiring coming up.
Right.
And it's not happening ASAP in the next month or so they're not in an urgent. But they want to know, what's the value of my house? So I've been doing some market analysis.
Right.
But I think the second piece, which I always tell them, is reach out to your lender, or can I provide you with a lender? Because this scenario may be better for them, where they're not quite ready to list yet, but they get another option in mind. Because who knows, in 6 months, something might come on the market that they really, really like.
Right.
And things, change, and you get that call, and we can put it on the market, and then they have that option to work with.
What do rates look like on a bridge loan? I imagine
Yeah.
that's a little higher.
Well, it's just like a HELOC, so it's going to be based on prime minus a half.
Okay. And a HELOC, I know what it is.
Home
but
equity line of credit. So that's what it is. A bridge loan is just a fancy name for
or a HELOC.
a HELOC.
Okay.
Yep.
So,
And they're not going to have, so the home equity line of credit is also interest only. So even though you might be using a good chunk of that money, it's only an interest only loan.
Nice.
So.
Right. I love it.
And then you're going to be paying it off.
loan
loans
limits.
when they sell. They'll be paying off both loans.
Right.
Was hoping we could talk a little bit about loan limits. I know that there were some changes, and I would say we work primarily, but not exclusively, in the Worcester County market. And I always felt as though Worcester County sort of got the shaft on.
Ignored.
Just a little bit when it comes to loan limits, because they are so much lower. I have had borrowers that have come to view properties with an FHA loan that had a very high amount on it. But in Worcester County...
Yes, I got that written down
You do. Worcester County does not like those high numbers. So tell us about that.
They've gone up quite a bit from where they were. I mean, I can remember when it was like 275 not that long ago. So they're up to 498, 257. I don't know why they come up with these obscure numbers.
Just under 500.
Like the $7 makes a difference, right?
Yeah.
Okay. A conforming loan is 766, 550.
Wow.
Okay, so that would be your conventional...
That's a conventional loan, conventional financing.
And because the next step is jumbo after that, right? So it's...
Okay,
sit tight, Lana.
All right, sit tight. So we have a portfolio loan program. It's a fixed rate loan for anything over 675. So that's almost, not quite, $100,000 difference.
Oh.
And we'll go up to 1.350 million with a 740 credit score, 38% debt to income ratio with 10% down.
What?
10% down.
Wow.
And that rate is going to be about 0.25% lower than a regular fixed rate loan.
And I have some new construction that would be great for that.
That would fit right, because the 675 to 766, 550 to get a lower interest rate is a big deal.
Yes, I agree.
It's a big deal.
So this just came to the top of my head. I have clients that always say, okay, well, I don't know. I'm not going to stay with this lender because of the rate. And you just talked about some of the rate,
they vary.
Right, they vary. So when someone says to me, oh, well, I don't want to go with this lender because their rates are too high. What's the recommendation that you give these borrowers?
They change day to day.
Right.
So you could talk to a lender on the first Friday of the month, which is usually the worst day for rates, because that's when all of the unemployment numbers come out, job claims, all these indexes come out, and they can be kind of crummy until the market digests the information. So if you could be talking to a loan officer just like on a bad rate day, not necessarily a bad loan officer. Mm-hmm. It's just because they do change every day. Like, back in mid-January, I mean, we were sitting kind of early January, we were kind of sitting pretty like mid-sixes, kind of poking down into the lower sixes, and then boom, we got some reports out early February, and it kind of sent things into a tizzy again. So, and I'm not opposed to adjustable rate mortgages.
I was just going to ask you about that because there's a lot of ARMs out there. So tell me, what do you have?
And, a lot of people, I talk about ARMs and people like, arms, what's an arm? I'm like, well, it's not an arm and a leg is what it is. It's a good option.
Right.
For first-time home buyers or even, first-time home buyers, they're not usually in their houses more than 7 to 10 years. And we have a 10-1 arm, which I think is a super stable loan.
That's super compared to the one.
So
One of my
I
guys
don't know.
has
I don't know.
7-1.
3-1 is kind of like 3 years goes by fast.
7 and up.
7 and up.
Yeah.
can you dumb it down a little bit? So when you're saying 10-1, 3-1,
Yes.
7-1,
Yep.
what does that mean?
Yeah. So a 10-1 arm is in the lending world, it's kind of looked at as a fixed rate because it's such a long period of time. So it's an introductory lower interest rate for the first 10 years. Nothing changes. Stays that low rate. On the 10-year anniversary of that loan, then the rate will adjust. And then it'll adjust annually after that.
Now, let me just ask something. It adjusts, but not just go to whatever the interest
No,
rate is.
there's caps.
Got it.
Right.
Okay.
So it can only go up so much.
But what if the interest rate is dropped lower than...
It can go down.
Oh, it can.
See, that's the thing. People are so in the mindset, if I get an arm, the rate's going to go up. It could go down. I've actually had people call me 6 months, a year before their rate's ready to adjust and say, I need to refinance. And I'm like, no, we're not refinancing you. Are you think you're going to move in a few years? Yeah, we're going to probably move. I go, we're not I'm not going to take your money to refinance you.
Yes.
Because that's just that much less you're going to make in your profit.
I had to chuckle internally here for just a moment when you said, no, because I remember all the times I kept saying, should I refinance now? Not with an arm, but with my conventional fixed, and asking as the rates were going through the drops, and you were like, not yet, not yet. And then I get the message, okay, now is the time.
Now is it.
And I loved that you were watching. I felt like I had my financial guardian angel looking over.
Well, you were out selling houses.
So,
not being concerned about, because I'm the one looking at the computer screen all day, looking at rates and what their movement is, and being on that button, right? Like having a loan that's in process and being like, today's the day, And I always text people first. We always get permission before asking for forgiveness to be able to, get them locked in. And if I can't get them, I'm calling you and going, I got to do this. But so anyway, back to that client, I said to him, I'm telling you, your payment's going to drop by like $300 a month. Sit it out. He was a wreck. And I still remember his name, Bill. And I said, Bill, just hold tight. And he did. And he's like, oh my God, Jacqui, it did go down like $300 a month. I go, right. Just let it ride. It's going to be like that for the next year. You don't need to make another decision. And I said, in a year from now, we'll talk about it again. But he ended up selling and buying another house. So he really appreciated it. We got him into a fixed rate because it was the move up house.
Yeah.
So at the arms again, let's just talk about that briefly. What does it look like in Salem 5 right now for?
6.75 on the 10-1 arm, and I would say the 30-year fixed rates are hovering in the low sevens.
Yeah.
There was a time where the 10-1 arm was almost a whole % lower than a fixed rate. And that was like a real good selling point. Now they're a little bit closer because the yield spreads are a little bit tighter. So it's sometimes it doesn't make sense to go in an arm and we just throw them into a fixed. I will say FHA rates are usually lower than conventional rates too.
Yeah.
Thing about that is the PMI being on there forever. So,
but you don't need to put down less than 20% and use FHA, correct?
Say that again.
All right. So if I decide to use an FHA loan, I know that typically FHA is 3.5% down, and you're financing the rest. So you could put more.
You still have the
get
PMI.
The lower rate.
Yeah.
So even if you're putting 20% down, you still get PMI. All right. I did not know that.
So somebody who's going in an FHA loan with 20% down could have other factors, such as maybe they had a bankruptcy that's just 2 years old. That in that case, we'd have to look at FHA as a financing. There's always a reason why we have to pull out the old FHA.
But you never lose the PMI no matter what.
No, unless you refi.
Okay.
Yeah, unless you refi.
So-
and they'll go higher on debt to income ratios. We'll go up to like 55 on that.
Ooh, right.
I know.
Yeah.
So how does someone qualify? When you're talking about credit scores and debt to income, DTI,
Yeah.
debt to income requirements, what is the absolute lowest that you can get somebody approved for a loan?
Lowest
Credit score.
credit score. I want to say our FHA is like 580.
580. All right, and that's so it doesn't.
Because that's what the lenders that so on the FHA and VA loans, we do sell those to investors. We don't hold the paper for government loans.
Right.
And that's kind of normal.
Those are insured
by the government.
Okay.
So should the loan go into foreclosure, the bank doesn't take the hit on it.
Right. Right.
Okay.
Yeah,
so
right. The government does.
I am a borrower and I have a 580 credit score. Can I be a current homeowner and get FHA financing?
Depends.
It depends. Well, you also might have to have other compensating factors. Like if you have 20% down and you have a 580 and a job history, yeah, it probably will go through DU. That's another acronym. Desktop underwriter is what we have to put every loan through.
Yep.
And that gives us our findings.
Yep.
And it has to be approved eligible. So...
Because I oftentimes get calls from buyers and, we're ready to start looking. We're so excited. Our credit score is good or we've been working on it.
Yeah, we've been working on it. Yeah.
One of the things I think buyers don't know or don't think about is what you do for counseling.
Right.
So even if you're a second-time buyer and something happened, identity theft or whatever that was out of your control,
we uncover a lot when we run a credit report, things that people don't even know are on there.
Right. So I tell people that the first and foremost place to start is contact the lender, and the lender can also counsel you to get to that spot to buy quicker than you think you're trying to clean up your act, right? So even if it's not a mistake of your own or something happened or you lost a job or whatever the case may be, you looking at it would go a lot quicker than them saying, okay, I'm just going to pay down this, get rid of this credit card.
Sometimes they don't know.
Right.
What you should be paying and what you should be leaving. And so many people close out credit cards that they've had forever.
I think you made me open a credit card. I think you made me open a credit card.
I think I did. And then we went shopping.
But she did.
And then you paid
and
it
I made
off.
her use it. And
I did.
She paid it off before the bill even got to her door.
I see. I'm
that's
like
what
that.
she
But
does.
It's funny that people, I've said this over and over to a lot of buyers, don't freak out about your debt right now until you talk to the lender because you need debt, right?
You do.
You need debt.
Because I have borrowers who are like, I have no debt. I should be fine. And I run their credit report and they are like a 660 because of lack of credit.
Right.
Not because they didn't make any payments on time, but they might have, like I had a borrower I just talked to, he had an Old Navy card, Old Navy, and it was another store credit card, right? And it was zero balance on it. And his credit score was okay. And I said to him, this weekend, you're going to Old Navy, you're going to buy jeans. You're buying jeans. And he's like, I need jeans. I go, yeah, you do. You need jeans for your closet.
You didn't tell me your size?
No. You need jeans for your closet and you need jeans for your credit score. I said, because you're not utilizing it.
Yeah.
And he's like, oh my God, all right. So I don't know if he went out and bought jeans, but that's what I told him to do. But those little things can add up. And I also have a lot of people who, I just bought a car and the dealership told me that I had, a 750 credit score. Mm-hmm. Dealerships usually will only use one credit bureau.
Oh,
we use three.
You use three.
So we use the median of all three scores.
Okay.
So if you have a 660, a 700, and a 750, we're using the 700.
Got it.
I'm glad you brought that up because when you have a credit card and you go onto your account, your website, you can click where it says, your FICO
Oh, we're going to
score.
talk about that.
So, yes. And,
Bring
and
it,
so,
bring it.
All right. And I look at that number and I'm like, well, that's real pretty. But when Jacqui ran my credit, it didn't look like that.
Okay. And that's perfect segue, Sherri. So the reason being is when you are looking at your Credit Karma credit score or the credit score that you get from your credit card company, That's a score like if you were opening up a credit card. Okay? This is not credit card. This is a 30-year commitment with a property. So it uses different algorithms to calculate the credit score.
I never knew this.
Right. It's looking at like if you have a credit card with a $10,000 limit and you owe $8,000 on it, your score is going to be lower when we run the credit report. But it might be just fine for another credit card company because they spend money. They like to hold 30%.
Yay for them. They spend money.
Yes.
Right.
You see what I'm saying?
Yeah.
Yes.
So the score can be from Credit Karma to what we pull 30 to 40 points lower sometimes.
Lower.
Yeah. It can be much lower. So
I
just
believe
keep
that.
Yeah,
Yes.
it can be. I feel like the Credit Karma and the credit score they get on their credit reports sometimes are inflate their ego and they're I'm going to
My
go.
ego was
I'm gonna
just
buy
fine
a new
after
car.
seeing-
Yeah. Yeah.
All right. So here's my question about credit.
Pull.
Yes. So my clients, I need to get an updated pre-approval, qualifying letter, whatever. And they're like, I don't want to do that because they're going to pull my credit again. So how does that affect them when
So great question.
Okay.
This is a good one.
Okay.
We're going to talk about two aspects of pulling credit. First of all, when borrowers are looking for a lender to start out with to be pre-approved, so two parts, right? We do have to pull a credit report, and 3 pulls within 30 days counts as 1.
Oh.
So you can shop around. I tell people if they've already got their credit report, they've already went to another lender to have their credit, find out what it is. I can give you a rate without running your credit report. We have a program in our computers where I can plug in like Joe homeowner with this credit score and kind of tell them what the rate would be. So that I just feel like it's more of an honorable thing to do. Like, because I understand people get nervous about having their credit report pulled too many times. And then other people are like, pull it, I don't care. Right. So you have to test the temperature with their level of comfort with pulling credit too many times. Yeah. All right. And then now we're going to talk about they're pre-approved.
Right. You pulled it already.
We've pulled it already and they're out shopping. And let's face it, most first-time home buyers, even move-up buyers, it's taking a lot longer to find a house. Mm-hmm. And they don't want their credit pulled every 90 days. Mm-hmm. And it's 90 days because the credit report is good for 120. So we have to give that leeway of the 30 days to close.
Okay.
I don't. Like if I know somebody who's shopping and they're really solid people, I'll just say, nothing's changed with your credit, right? You didn't open up any new cards, have any late payments. And I kind of just go off of that trust because a lot of people are also previous clients too.
Right.
So you have that level of comfort that they know what they're doing and they know better than to open up new credit and things like that.
Right.
So this is your to don't list, right? That you give people.
I do give people a to don't list.
So, now, we have all these cute little sayings with Jacqui. One of my favorites is the come to Jesus talk.
Sorry, Jacqui. I knew she was
I
going to
didn't
bring
know
it
if
up.
I
I
was
asked you avoided it.
I know.
Okay.
I know.
I think this needs to stay in.
Yes.
Because, I don't care who you are. We all think and act a certain way. Mm-hmm. And occasionally we need someone to bring us back to earth or talk to Jesus just a little bit on how we need to straighten things out.
Jesus wants you to buy a house. He wants you to have that, he wants you to be in a safe, secure home.
But I don't think I want to have that speech from you. That scares me.
It's not scary. It's not. You know what? I treat people like I'd want to be treated. And I talk to my clients the way I'd talk to my own kids and my own family and friends. There's no candy coating anything. I'm not going to set people up for disappointment. Right? Let's have that disappointing call right now. Let's head it off.
You don't start with the, I brought you into this world, I can take you out if you don't.
No, but I have had that said to me by my mother.
I may have said it, right?
We may have said that
just on occasion.
But I feel like people deserve an honest conversation with a lender because there are blow smoke up your you-know-what loan officers and they're like used car salesmen. Yep. And that's not, it's just not how I am. It's not how I want to build a rapport. I want total confidence with people that I want trust, right? So that initial phone call
Makes
is
sense.
a trust building phone call. And I get them to like relax. This is not the dentist. We're not doing a root canal. This is just a conversation. Let's just talk about things. And I love starting out my conversations like, what are your home ownership goals? What are your dreams?
Right.
Because that's important to me. Like, I need to know where do you want to be? I want a new house so badly. Well, let's get you into that new
Everyone's
construction.
got a story.
And I've said that one too. Tell me a story. Because everybody does like to, who doesn't like to give a little bit? But
you wanna personalize it.
they can drop a little nugget of information in there telling me about themselves that will alter what loan program we're going.
See, and that's the piece that I've learned from you is that you take the time, and I said this to the last buyer I just referred, that you need to speak to a lender that will understand your circumstance.
Right.
And what I mean understand is you need to discuss what was going on and what has been happening, and she will help you find
There's
the
no
right
judgment.
one. Right.
There's never any judgment. People have had stuff go on in their life that has affected their credit, or they've had to leave a job because they were unhappy. And let's work through it. Tell me what the problem is that you may have in your financial situation. I'm going to try to solve the problem before it gets to the underwriter.
Yeah. Right.
Because we don't want the underwriter going, what are you doing?
Right.
Let's solve the problem and work backwards. And
I mean, if something can be fixed, why wouldn't you? Why wouldn't you go there? So, it's great when we make it to the closing table and there's all those celebrations and everything that goes on. But on occasion, and I'd like to think it's a very small percentage, it doesn't get there. It doesn't get there.
Yeah.
What are some of the more typical reasons that you have to deny a loan?
Well, my loans don't get denied.
Oh,
But
I love that.
Yes.
Because
I know.
Okay, so we won't say you. Well, let's just say
another
in
lender.
general.
Yes.
In general.
Okay.
All right.
Yes.
What would deny a loan? A late payment on a mortgage, because we do run a credit report right before closing.
Okay.
Not run a credit report. It's more like a
soft pull.
Yeah,
right?
and especially when a loan is in process, our credit bureaus actually alert us if there's a late payment.
Oh, gosh.
Yeah, we get alerts.
So then they get the call.
And then we get the call.
So
I can't stress enough, just make your payments on time. Don't be late on anything.
Don't go buy that Porsche.
Don't
right
buy
before
furniture.
close.
Don't buy furniture for your house until you own the house.
Who don't list.
don't put your deposit on your
Credit card.
on your wedding day event. That has happened way too many times.
We've had that.
Right, where people are planning their wedding after they buy and they go, oh, well, they need the deposit.
Yes. I think we had that.
yes.
Is that why you brought that up?
And then what about,
'Cause those are those moments.
somebody losing a job?
Well, if they lose their job, we usually know that in advance of the closing, or if they get laid off, and usually their deposit is refunded because of the commitment date, right? We can't verify income.
Well, even mortgages typically on an offer is a contingency so that the buyer is protected if for some reason they're denied, which I think gets into another question. You have pre-qualification, you have pre-approval, you have pre-commitment, and you have mortgage commitment. All these different terms, what do they mean?
So a pre-qual is kind of like having a conversation. And that's a lender who probably just doesn't want to spend the money on running a credit report, because
I didn't know that.
we have to pay for them up front, whether or not they close or not. And they're $125 each now. So if you got two borrowers, Salem 5 is paying $250 to run the credit. It's,
Okay, I didn't know that.
I know. It's, yeah. So a pre-qual is kind of like, well, I think my credit score is this. This is how much money I have, and this is what my debts are. Okay, you're pre-qualified. Are you going to take a pre-qual on a listing?
No.
Right. So a pre-approval is one step more,
Okay.
where we have the most amazing software platforms for borrowers they can plug in their payroll company, and our bank will talk to their payroll company and pull in all of their. They don't have to pull in pay stubs and W-2s. It all comes.
Nice.
It flows right in.
Nice.
Spent a lot of money on that software to make it easier.
Right.
So we run the credit report. We've got the income. We've got the assets verified. We run it through DU. Here you go. Here's your pre-approval.
Okay.
In this market, even a pre-approval sometimes isn't enough. Right?
No.
So we did one step further, which is a pre-commitment. So a pre-commitment is we're not picking out an address, but the loan actually goes to an underwriter.
Nice.
And the loan is completely underwritten so that the only thing we need, so verification of income, assets, credit, explanations for previous addresses, inquiries on the credit report, everything is thoroughly gone through. And the only thing we need is an appraisal.
So why would you, as a lender, get to that point of the commitment? Where is it your
because
practice?
it's just that one extra level in putting in an offer.
Which is great because as a listing agent, I call the lender and say,
where are
this?
they?
Yeah.
But I would say that has tremendous value to the experienced listing agent who knows to, pay attention to these things. You're in a multiple offer situation and you've got pre-approvals, pre-mortgage, whatever it is. I think we all say pre-approval, even though it may have different levels of, actual approval to it. But when you see that, I like when it details, what does this mean? Did we pull the credit? Did we look, did we get employment verification?
When you have people who are looking at $1 million properties, that pre-commitment is almost, it's like one step below a cash offer.
Yes.
Right?
Yep.
True.
Right. So it's just if you get a cash offer, we all know that that's going to be.
Cash is king.
Cash is king.
Yeah. But it's all cash on closing day.
It is, and it doesn't matter where it's coming from.
Nope. I just wanted to sing that.
We all love closing day. That's the best
day.
Closing day is the best day.
So when you do issue, because back to an offer or purchase and sale agreement where it says in there that you have a mortgage contingency. Now, when this contingency is met, that is generally the last piece that is protecting the buyer's deposit.
Right.
So a mortgage commitment isn't always 100%.
Which is why we get, sometimes we may need an extension if, say, the appraisal isn't in.
Right.
So if we have a pre-commitment and all we need is the appraisal, that loan's you're also going to be closing faster. Because you're going to order that appraisal right away. Because that loan's already in process.
Exactly.
But mortgage, I guess what I was getting at, mortgage commitment and clear to close, two different things.
Yes. Two different things. Yes. So at the commitment date, we want all of our internal, that's why I like the commitment date 10 days prior to the closing date. Because 10 days prior to closing is when we're verifying employment and we're doing the last, making sure everything is all set. It's not a pull that the borrowers are going to see on their credit report, though. It's
that
not
I
a hard
understood.
pull.
Yes.
Right, okay.
So it's a soft pull, but you're still having those just before closing
details
that need to be done.
Yep.
But they aren't generally going to impact the ability to get the loan. Right.
Well, they could if they're not working, or they could if they had a late payment, and we have to do a hard credit pull in the scores again to make sure the loan still works. And it may affect their rate and pricing.
Oh.
That's why we need that.
At last minute.
Yep, at last minute. That's why we need that 10 days to make sure. But we're sending out our CDs. Like as soon as we have all of the conditions in from the borrowers, we send the CD out. So everybody has signed the CD, but the clear to close isn't going to come until 10 days prior to closing date.
So when you say CD...
Closing disclosure.
There we go. And the closing disclosure has to be signed by law what?
3 days prior. But we will send it out. Right. But we will send it out as long as
Interesting.
Yeah.
Okay.
And everything's electronic.
Right.
They click,
Yeah.
sign.
Right.
So there's no like waiting for the mail or
I mean, unless
having to do
you've
it in
got,
process.
grandma, Edna that just really
No,
needs
I
to sit down.
no, I believe no. I will tell
I do
you,
have some techie older people that I actually
haven't
probably
had-
better than me.
I haven't had any problems with people.
No?
no,
No.
because it's an app on their phone or their kids will.
Or they're on the
Or
laptop.
they- yeah.
They, a lot
Or
of
they
them have an
they have an
iPad
app.
or
Yep,
a
they do it on their iPad.
Yeah, they like iPads because they're big and they
Yeah.
can do it.
I do have a few. Over the years, I've had a few people that were more comfortable, not necessarily lacking the skill, but more comfortable if I sat down and let them sign in person.
Yeah.
They just felt like it was more, had more substance.
Right.
I think at this point, my head is kind of spinning with all this
I know, a
information.
lot of information.
I mean, obviously, a lot of this is familiar to me, but I feel like what we've learned today took some of my knowledge and made it just a little deeper, and I appreciate
Because if
that.
you have, I think it's important as a real estate agent to have a good set of knowledge about the lending part of it too. And maybe you have a loan officer that you work with and you say, I think that this person would be a good fit, or
Right.
that person knows her stuff on condos.
Right.
And just making sure that the team
Yeah.
that you build
Yep.
is cohesive into making a smooth transaction.
Oh yeah,
I
100%.
have learned definitely some more information or in depth of information that was
Right.
surfaced for me. So I feel like what you've given us today is very valuable. And I
Great.
think our audience should think about a phone call to
Yes.
both
Phone calls are free.
us and
Yep.
Jacqui
And to you.
Keogh. And I think that you will get so much more knowledge and it will help you through that buying process.
Absolutely.
Yeah.
Please make sure that you're subscribing. We do hope to provide valuable content on a regular basis, and we want you to be aware and get noticed. Notifications. Another blooper. Okay. We want you to get notifications when we have new content out there for you. So thank you for tuning in.
Thank you, Jacqui.
We're already
Yes,
there.
thank you.
Thank you.
Wow, we did great. Thank you. Thank you. I'm glad everybody enjoyed
All
our,
right. And
our
if
TED
you're
Talk.
looking for Lana or myself, you can find us at Caldwell Banker in Leominster. All right.
Thank you.